Hi everyone, I'm Traci Krepper, joined today by Craig Lupton, and we're back for another edition of Credit Conversations. Today we're going to talk about consumer credit trends. Craig, last time we spoke, we saw an increasing demand for consumer credit cards. How has that trajectory continued over the last quarter?
Yes, so we had a very busy 2024 when we looked at credit cards. That continued basically into the end of the year. 2024 we saw 8.6 million credit cards open in total throughout the entire year, and that growth has continued into 2025. This sort of early weeks of the year, we're still seeing consumers coming back to market. Appetite is there for credit cards, and in fact 1/3 of the people that are applying this year have also opened a credit card in 2024. So some repeat customers coming through.
You know, you've mentioned that we're seeing consumers increasing the amount of cards. How are we comparing? How many credit cards on average does a person have?
It's gone from about 1.4 cards in their wallet to somewhere in the region of 1.6, and that varies across the age spectrum. On there we've seen greater engagement across older people with the credit card market over the last sort of 12 months on there, but people are holding more cards, people are opening cards, but they're not tending to close off those credit cards. So we are seeing a growth in the plastic in somebody's wallet or digital wallet.
Any reason why? What is driving that demand?
There are a lot of competitive products out on the marketplace that we have seen them opening up in terms of the available products to the full risk spectrum really. So we've got lenders that are going in sort of the more higher risk customers. We've also seen products being offered at the top end of the market to lower quality customers.
So more cards, more choice. What does that mean from a delinquency rate? Are we seeing them continue to make those payments, or are we seeing an increase in delinquency rates?
It's a good question because we've talked about opening up of risk, we've talked about more cards being opened or more debt being built on there. But what we're not seeing, and it's been pretty much the same through as we saw through the course of last year when we had these conversations, delinquencies remained relatively stable, relatively flat, but also it's identifiable and predictable. So it's coming from when we do see any emergence in people missing payments, it's from those groups where we'd expect to see that. There's a lot of resilience in the UK consumer base. Households are managing their payments. So at the present moment, we are seeing risk or delinquency emergence stabilised. We do foresee some bumps in the road coming forward. When we start looking forward to 2025, some of that unwinding is still to play through on there. So I think we will still see some rises in delinquencies coming through, and then we've got some headwinds obviously in 2025 which could affect consumer households.
From an unsecured debt, as we're talking more about these credit cards, what are we seeing in terms of the consumer trends? How many consumers are actually holding unsecured debt? What it means for them from a credit perspective?
Yeah, so we've seen massive growth in the card market. We've seen card balances grown. We've also seen growth in the loan space as well. On average, you've got 5% more unsecured debt per adult in the UK on there, which is quite significant on there. And this typically is the time of the year when obviously consumers will start to look at their finances, start to get them in order, start to manage those debts a bit better on there. So looking in a little bit more detail, there are 13 million consumers in the UK right now who are paying interest on some form of unsecured credit. So they're incurring interest, probably higher payments on the back of that as well on there. Now, if we look at some of our data from last year around our Experian marketplace, we saw approximately 3% of that population on a monthly basis looking for debt consolidation, looking for products out there that could help them manage their finances better, get those monthly payments down into more affordable sums on there. Now, half of those customers weren't being serviced with an offer. They would go into the marketplace, they were being turned down and said, no products available for you in the market. Now, some of that will be credit risk because they are a higher credit risk, but there are sort of half that population who are good quality, low credit risk. So it could be an affordability challenge that those consumers are facing on there. And that could be to do with the complexity around how consumers are assessed when they're looking for debt consolidation. You've got the debt they have and the debt that they're looking to try and take on, and how that all gets managed in that sort of affordability assessment on there. So I think that there are challenges there which may be a reason why they are not currently being surfaced a product in the marketplace.
So an appropriate solution for consumers in this space would be an ability to actually consolidate all of those loans into one place, give them the available funds that they need in order to pay off those loans, have money in pocket so that they can actually make the appropriate payments, not have to prioritize payments. It sounds like a very appropriate solution to help these consumers through this debt consolidation.
Absolutely, and ensuring those funds go to those relevant lenders, get those debts cleared down, it helps the consumer not just today but in the longer term as well in terms of their overall affordability position.
So from a lender perspective, it would allow for a decrease in risk, an increase in offers to those appropriate customers, less concern that they're not going to be able to make those payments, and a positive customer retention and policy for those appropriate refinanced customers.
Absolutely. So, and it allows those lenders to take on new customers, to grow, which is, a lot of the lenders out there today still looking at growth in 2025, and therefore it's an opportunity in the market.
Let's change gears now and talk about secured mortgage loans. With the stamp duty coming, what does it mean from a trends perspective? What do we expect to see in that secured market?
Yeah, let's start off by first talking about what has happened to the mortgage market through the course of 2024. Very turbulent start to the year, and then we've seen a recovery. We saw the first rate cut in summer last year. We saw some competitive rates in the marketplace. By the end of the year, we actually saw 4% growth in terms of mortgage approvals on there, which is good. And we started this year as well, so customers are there in marketplace. We took the mortgages that were lent between January and October last year, and just as an illustration, had a look at if the new stamp duty rules were in place on those mortgages, how many of them will be paying stamp duty compared to previously. So we started off with 60% wouldn't, under the old rules or current rules, would not have incurred stamp duty. If those new rules were enforced when they took those mortgages out, we're down to 38% of those mortgages. So quite a significant impact or proportion of those consumers that are now going to face, under the new rules or the new changes that are going to come up, the need to pay stamp duty on there. Now that causes a choice or decision for those borrowers. Okay, they need to work out how they fund that. Do they take it out of their deposit? Do they put that onto the term of their mortgage and therefore end up paying longer interest and changing their monthly payments going forward as well? So potentially a little headwind that may impact this recovery that we're seeing in terms of the mortgage market thus far.
Thanks, Craig. So on top of the stamp duty costs, consumers are still paying more. Interest rates are still higher than what they were 3 years ago. What do we expect to see continue from the cost of mortgages for consumers?
Yeah, so as we saw a couple of rate cuts in 2024, and then the outlook for this year is that, again, we're likely to see a couple more rate cuts throughout the course of this year, albeit those rates are going to come down slowly. So there will be positive impacts in terms of the mortgage rates out there for consumers, but it's not going to come down quickly throughout the course of 2025. We've got, if you look at the rates today, we've got 34% of consumers that are currently paying somewhere in the region between 4 and 6%. So you'd expect, as rates start to come down, that those consumers will be able to move off onto some cheaper rates. And in fact, the Bank of England are forecasting that 27% of borrowers today will be on a lower monthly payment on their mortgage by the end of Q4 2027. We've also got a pocket of consumers that are sat on sub 3% rates, so they've not yet moved on to these higher fixed rates. So they're going to have to go up that hill first before they can come back down. So there are some moving parts in terms of the mortgage market, but consumers, some will get a benefit in their back pocket in terms of being able to move off those early adopters on those higher rates onto some lower rates, get a bit of cash back in their pocket, and obviously benefit those households.
Thank you, Craig. It sounds like opportunity still remains, growth still remains in the UK. You have to find the right consumers, offer them the right products. We've talked about refinance opportunities, particularly in the card portfolio or unsecured portfolio, so that you're helping your consumers get them the right offers, give them opportunities to bring down some of the existing debt that they have. Mortgage market, there's definitely some opportunities as we see what happens to interest rates, new opportunities for growth throughout the market.
Yeah, I think there are some cautionary notes that we just need to be mindful of, so you can use the right data to get the right consumers and make sure you get the right behaviours from those consumers as well.
Great. Thank you very much. See everyone next time for our next credit conversation.